Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today we are on the first chapter of your second part, that is accounting for share capital. Now share capital, like you have studied capital, right? Capital means what? The money that is being invested by the owner of that particular business. But share capital, that is also the money being invested by the owner of the business. Okay, which business, which form of organization? Company form of organization. Now you have studied the sole proprietorship, you have studied about the partnership. Today we are going to study about the company form of organization. I'm just going to clear the concept related to it. What is a company, why there is a need to form a company, right? Now let's start again with an example. Let's say there is a girl named Raya, right? She cooks, bakes nicely cakes, pastries and cookies. So she decided, why not to open my own business? Why not become an entrepreneur? So she decided to open a shop. Okay, Raya, she opened a new shop. She became the sole owner of that particular shop. She invested the amount of money. The money being invested by her is known as capital, that you all know, right? She invested that amount of money. She started taking decision what to bake, what not to bake, how much will be the price of certain things. Whatever decisions, they were solely being taken by Raya, right? And at the end, whatever there was a profit or loss, whatever she has earned or incurred a loss belongs to her only, because she is the sole owner of that particular business, right? Now Raya said, I want to grow my business. Okay, I need certain more amount of money, but I'm not having sufficient capital. So she knows one of her friend, let's say Raha. Okay, she invested 50,000 rupees. Okay, she invested 50,000 rupees, but that amount was not sufficient enough if she wants to grow her business. Okay, now she wants more capital. Let's say she wants 5 lakhs. Now from where to bring 5 lakhs? So she decided to ask her friend Raha that let's be partners. Raha also saw her business is growing well, and she was like, okay, let's be partners. Let's own this bakery as a partnership firm. Okay, so Raya and Raha, they become partners. Raha bringing certain amount of capital, Raya, let's say both bring 2.5 lakhs in that particular bakery shop, and they started this business. They both used their own skills and expertise, and all the decisions now were being taken by both of them. Okay, earlier only Raha, she was the sole owner. Now Raya and Raha both are the owners of that particular bakery shop. So both, they are now the partners, so the decision will be taken by both of them for that particular bakery shop, right? And at the end, whatever profit is being earned or loss is being incurred will be shared among both of them. That is what happens in a partnership firm, right? Now they are like, we need more amount of money. Let's say now they need 50 lakhs. 50 lakhs, it's a big amount, right? If I need 50 lakh, I just can't go to somewhere and ask for 50 lakhs. Even the banks and financial institutions won't give just like that 50 lakh. They need to see all the things of your business, and after a point, after that they will give some amount of money. So now they need 50 lakhs. They can't go to their relatives, friends and ask for money just like that. For that, what they decided, okay, let's form a company. Let's form a company. Okay, now why company? There are many benefits associated when there is a company form of organization. Now that is also called association. Let's say they went to certain other friends, they said, okay, we will invest money into your company, right? When they invest money in a partnership firm, when they invest money in a partnership firm, other friends of theirs, they invest money in a partnership firm, or let's say when Raya was the sole owner and other people invest money, what happened as the partners? Okay, like let's say as a partners, when 4 or 5 friends invest money in their partnership firm, they also become the owners. But what is the major drawback in that case? There is an unlimited liability. Now what is an unlimited liability? Let's say if the business fails, okay, there is, they decided to wind up that particular business, their firm. Now if the firm's liability exceeds the firm's assets, then in that case what they will do, they have to use their personal assets, right? Whatever money they invested, that is gone, their capital amount is gone. But let's say there was 5 lakh they have invested, that is gone. But let's say firm's liability is 10 lakhs, okay, and firm's asset is 7 lakhs. Now 3 lakhs, where these 3 lakhs will come? So personal assets, Raya and Raha's, moreover other friends who invested money, who became the owner of that particular firm, their personal assets will be used to pay off the firm's liabilities. Okay, so these 3 lakhs they have to bring it from their own pocket, right? Whereas if they form a company, form of an organization, and they decided there is an association of a person who decided, okay, let's carry on this business, in that situation the major advantage is there is a limited liability. Limited liability means, let's say 50 lakhs they want, somebody invested 5 lakh, somebody invested 10 lakhs, somebody 15 lakhs, somebody 25 lakhs, 30, and another one 5 lakh, like that they invested. So their the liability is limited to this much amount of money, the capital that they have invested to that particular form of organization, that is in a company. Whereas in this case, if there is a partnership firm, they have unlimited liability. Even when Raya solely was carrying on the business of bakery, and if that bakery business doesn't go well, and if she decides to wind up that business, so Raya has to bring her personal assets to pay off the that particular business liability. Whereas in this case there is a limited liability. The other person, the other owners, who form a part of that particular company, they don't need to bring their personal assets. So major thing is people are ready to invest in that particular company. Okay, limited liability. Moreover, the banks and the financial institution, they rely more on company form of organization rather than partnership firm on a sole proprietorship firm. Now you will be like, why rely? Now let's say there is, like when I talk about a partnership firm, okay, they entered into a deed. It can be mutual, it can be written, oral or written. If it is oral also, they can continue with that partnership form of an organization. There is, even though there is nothing written in a partnership deed, there is an oral mutual agreement to carry on the business, right? But in case of company, it is not like that. The Partnership Act, when we talked about the Partnership Act, when the Partnership Act comes into picture, when something is not mentioned in the partnership deed regarding the interest on capital, drawings, all these remuneration thing, when something is not mentioned in the partnership deed, then whatever is mentioned in the Partnership Act, that they need to follow, right? Whereas in the case of company comes into existence only and only if there is a governing body, there is one governing statutory body who will allow a company to form only if it fulfill certain condition, and they have to act as per the provisions of law, as per the rules and regulations that are being formed. That governing body is Companies Act. As per the act, whatever is mentioned in that particular act, they have to follow in that particular way, right? They get their certificate of incorporation from the registrar of companies. They get a certificate, yes, this is a company. And when they have a certificate, the banks and financial institutions rely more on that particular certificate. Now let me take one simple example. I'm not saying anything is wrong in that. There's one student who has done homeschooling, okay, and there's one student who has studied from school, right? Now both the students are there, both the students are capable, but the major drawback for that particular homeschooling student, even though he is very good in everything, he has lots of skills and expertise to do certain things, but the drawback is he's not having certificate from any particular governing body. Whereas in this case, the student who has studied from a school, that student has a certificate of school that yes, this student has studied, this student has followed all the laws, all the rules of this particular school. These schools are being also majorly governed by a body. Okay, there's an education board who governs them, and these schools then give certificates to these students. So when they apply to any kind of a university, this student, homeschooling student, is very good, but he has to give certain tests and then he will be enrolled in particular university. Whereas in this case, the school going student, he's already having a certificate. There is a body who has given their assurance, and this university will easily accept this student. I am not against the homeschooling student, mind it, this is just a purely example. So when the companies have a certificate from a governing body, then the banks, financial institution will easily lend money to them. Whereas in case of a partnership and sole proprietorship, they won't give such a huge amount just like that, right? So that is why a company is being formed. Now, company may also be viewed as an association of person. It is an association of person. It could be a private company, public company. What is it? I will explain to you later. But it is considered as an association of person who contribute money or money worth to a common inventory and use it for a common purpose. There is a common purpose behind it. They use that money for that particular business, and they earn, the major purpose is to earn profit, right? So that is why a company is being formed, but it has certain features which this sole proprietorship or partnership firm is not having. What are the key features? There is a body corporate. This is the main feature. There is a body corporate Companies Act. So this company have to work as per this is formed as per the provision of law. The company is being formed as per the provision of law. There is a body corporate who is governing all these things, right? There are memorandum of association, they have to get it signed. This articles of association, they have to keep the annual general meeting. Like, there should not be a gap of, I think, more than 120 days between two AGM. So all these things are being mentioned in the memorandum. All these things they have to give, like how much of the capital would be there. All these things are not in the case of sole proprietorship or partnership. They can bring in as much capital as they want. Whereas in the company's form of organization, they have to mention how much will be the authorized capital. I am going to discuss about all these things, but they need to mention everything. Okay, this much will be the capital amount, this situation, the all these things will work out, who will be the board of directors, who when the AGM will be held. All these things are being mentioned. So there is a body corporate who is asking them to do all these things, so they have to work as per the provisions of law. Secondly, this is a separate legal entity. Company is separate, the owners of that particular company are separate. They are not a part, they are not considered as same. Whereas in this case, when Raya was the sole owner of that particular business, whosoever will come, they will ask Raya, if they want to contact somebody, they will contact with Raya. Or in case of a partnership firm, they won't consider, okay, these Raya, Raha, they are the face of that particular partnership firm. Whereas in case of a company has its own identity. Who are these board of directors? They are a part of it. I'm not saying they are not a part of it, but company has its own identity, own pehchan in this organization. So it has a separate identity, whereas the owners are separate from it, right? Thirdly, it has a limited liability. In these cases, they have to use their personal assets. They have to bring in the personal assets in case of liquidation, in case of winding off this particular business. They have to bring their personal assets if there's a shortage. Whereas in this case, in the case of a company, they have a limited liability. Whatever amount they have put into the business, that's it. More than that, they are not supposed to give to the, no, none of their personal assets will be used to pay off. Okay, there are certain like things, there are certain people who form the organizations, right? I don't want to take the example, but you have studied about where so many people who just leave this country and go to another country because they have downfall in that particular company, right? And when there is a downfall, that particular person's assets are not used to pay off, to their workers, to their employees, anybody, right? Whatever the assets of that company are there, that assets will be used, not that person's personal assets will be used, right? So in this case, there is a limited liability. Next is perpetual succession. In case of a sole proprietor, let's say Raya pass away, who will carry on the business? Nobody in her family knows it, how to, bakes and all these things. So if she passes away, there is no one to carry on the business shut down. Or in case of a partnership also, we studied when there is, in case of a winding of a business, if a partner become insane, if there is a death of a partner, at that time also the firm winds up, right? Whereas in case of a company, anything happens to the owner, doesn't matter, the company is going to continue, it's least bother whatever is happening. There will be somebody who will replace that person, right? There is going to be somebody who is going to replace that person, but company won't stop, company is going to continue. So there is a perpetual succession. Next is common seal. The company have a common seal. If Raya, in case of sole proprietor, she have to sign a document, she have to personally sign it, right? In case of partnership firm, 5 to 6 partners are there, 5 to 6 partners have to agree, they have to put their mandatory signature. Wherein in case of a company, they have, company, as it says, it has its own identity, it's a separate legal entity, it has its own common seal. Whatever documents are there, they need to just put that seal, right? No need to sorry, no need to have the signature of the board of directors or all these owners for that particular thing. Common seal works for it. Next is transferability of shares. Now shares is a wide topic which we are going to discuss, but what is shares? Let me explain to you. Now this case, we asked for 5 people, right, for money, but they want more money, right? Like when they went to the general public, nobody will give it like that, right? They need a kind of an assurance that yes, we have given money into this particular company, and in case of we want that money back or something like that, we need a certificate for it, right? So what that particular paper is called, it is called shares. Okay, that is a share certificate, you must have heard of it. That is a share certificate that yes, I have given, like the company will say that yes, this particular person has given money to me for my business, right? For this particular company, from not to me, to that particular company, this person. So that is kind of a proof, you can say that yes, this is a proof that this is person has given money. What are shares? It's a share in that particular company. I have my part in that particular company, so that is considered as shares. So now if let's say I am holding a share, right? I am holding a share certificate wherein I say, let's say on ABC company, I have invested money 5 lakh rupees, right? Now I need 5 lakh rupees. Okay, if I go to somebody, that company right now won't give money, right? This is the capital that I have invested. Now I am the owner of that particular company. At the time of wind up of the business, if the company is having money, they will give it to me, otherwise I won't get it. This is the thing, right? Now buyback of shares is also there, that is advanced, we'll discuss about it later. But let's say I need now money. Now I need money, where to go? I have these shares, where I will go? I'll go to the bank, financial institution, or else to one of my relatives who is having money and who is good in, who likes to invest in companies and all. So what I will do, I'll go to my relative and I say, sir, please, I need money, I am giving you shares of this particular ABC company, and you become now the owner of that particular company, he will easily accept it because he is now having the proof. So the transferability of shares is easy in case of a company. Just like that, I can just transfer the shares, I can get my money back. Okay, so that is the case of transferability of shares. Next is may sue or may be sued. The company can sue any person. If somebody has used its patent, copyright, trademark, all these things happen, they can sue any other person, or any other person can sue the company also. Okay, so these are the features what a company hold, which is not there in case of sole proprietorship or partnership, and that is why there is a requirement to form a company. Now when we say a limited liability, for limited liability there are three forms: limited by shares, limited by guarantee, and there is a concept called unlimited liability. Now this unlimited liability concept is there as per the Companies Act, wherein the members' liability is unlimited. That is, if in case of liquidation, personal assets of the members will be used to pay off the company's liabilities. This concept is there, but there is no such company in existence. Okay, there's no such company in existence wherein there is a case of an unlimited liability. So when I say limited by shares and limited by guarantee, limited by shares, as I explained you what are shares, that is like if I invested 5 lakh rupees, my liability towards that company is 5 lakh rupees. Okay, I am not supposed to give more amount of money except for 5 lakh rupees, right? Let's say I have given 4 lakh rupees and the company says 1 lakh we will demand you as and when required, maybe in case of a liquidation. So my liability is limited till 5 lakh. 4 lakh I have already given, so my liability will be more 1 lakh rupees only. Okay, so this is limited by shares. Okay, next is limited by guarantee. Guarantee means I have guaranteed a certain amount of money to that particular company. Let's say I have guaranteed 10 lakh. So whatever amount I have guaranteed, that much liability I have towards that particular company. So when I talk about liability, there is a company, it's liability to the share amount, liability by shares, liability by guarantee, and unlimited liability. Okay, so this is how a company is being formed, and there are now 3 forms of company. Earlier there were 2: private company and public company. Private company means what? Let's first talk about the private company. Private company means what? That this company is not asking money from anybody else. From the general public, they are not asking. Whosoever are the members of that particular company, they are going to use their money only whatever is they have decided. Okay, this is limited by shares or by guarantee. Okay, so private company, there can be 2 members minimum or maximum of 200 members, and this is what they have decided. It is an association of persons. They have decided, likewise I discussed, these are 5 people who have decided to form a company, and that is a private limited. The thing is, they have to mention that this company, so and so company, is private limited. It's not public limited. So they have invested that amount of money into that particular company, and their liability is limited to that particular amount only. There could be minimum of 2 members and maximum of 200 members for a private limited. Next is public company. When I say public company, means there has to be a minimum of 7 members to form that particular company. Public company, anybody can invest in that particular company. I don't know whether you have heard this word, IPO, initial public offering, right? They will go to the security board, they will ask money from they will first apply for it, the Security and Exchange, SEBI will see to it, and then it will approve, and then the general public can invest their money into that particular company. So general public can invest, that is a public company. So one which is not a private company is a public company, that also you can say, right? So in this case also, the general public, nobody knows who is the owner. Okay, they get the share certificate, they are now the owners, but the public is investing money into that particular company. It's a public company. And now there is a concept called one person company. Even earlier it was not there. Okay, now it has come into existence. Even one person can carry the company. Okay, that person amount will be there in that particular business. There are certain rules and regulation that person has to follow. Let's say Raya, she was the sole owner, she decided to form a company. Now what happens now, like in these situation, when it is a company, the credibility increases. Okay, likewise I said the bank, the institution, if somebody else want to trade with us, if there is this company name written on it, that this particular is a company, somehow it's become a kind of a brand, right? Like the if there is a brand name on it, you will easily go and buy those particular things, may it be clothes, may it be your smart watches, may it be your mobile phone. If the brand name, brand logo is there, you will easily put your money onto it. So similarly, the credibility increases. Okay, if a person wants to trade with somebody outside India, the person sees to it, it's a company, because has a body corporate, it is being ruled by the Companies Act, means this particular person is going to follow the rules and regulation, it is being governed by somebody. So one person company, there is certain limitations of minimum turnover, the amount of capital that the person needs to bring, all these things are there. I think 50 lakh amount is there. So all these things are there in case of a one person company. We are not supposed to go into detail of all these things, but there is a private company, public company, and one person company. Now how they will ask for money from the public? Okay, what will be this, all these things, the capital amount you have studied about, like this balance sheet, right? Balance sheet, there are assets, there are liabilities, right? All the assets, fixed assets, current assets, all these things are there. In case of a liability, there are third party liabilities. Okay, third party liability, and there is a term called capital. Okay, capital means the amount being invested by the owner of that particular business. In case of sole proprietor, that capital belongs to it's of the sole proprietor. In case of partnership firm, they will mention how much capital every partner has brought into the firm. They will mention, like Raya brings 2.5 lakhs, Raha brings 2.5 lakhs, like that it will be mentioned. But in case of a company, there will be share capital. This term will be used. 50 lakh amount of share capital is there. Okay, with a nominal value. They all have a nominal value. In the next video, I am going to discuss about what is a share capital, what are the terms are being used in that authorized issue, all these things. I hope you got to know this concept behind a company. Next Wednesday we are going to discuss about it. I hope you got it. See you next Wednesday. Till then, thank you very much.